In the last video of the module devoted to the formulation of financial strategies, we will be dealing with behavioral finance and its impact on financial strategies. In previous videos, we discussed the key themes related to the financial strategy of a company, such as sources of financing, dividends, and risk management. When describing those aspects, we emphasized their role in the process of creating company or shareholder value, with the underlying assumption being that investors are rational and logical in their decision making. In particular, we typically assume that investors analyze all available information coming from the market before deciding whether to invest into or divest out of the debt or equity instruments of a given company. However, anomalies such as cycles, bubbles, and crashes, which are frequently observed in the stock market, suggest that this is not always the case in reality, and that under some circumstances, market participants fail to act in a rational way. Possible sources of such irrational behavior are suggested by behavioral finance, a field of study which attempts to incorporate lessons from psychology and cognitive sciences into traditional economics. According to behavioral finance research, decisions made by investors are more often taken based on emotional and psychological mechanisms rather than the analysis of facts and available information. A typical example of such mechanism is herd behavior, causing investors to mimic and blindly follow the decisions of others and giving rise to such market anomalies as excessive booms and crashes. It seems that herd behavior is a manifestation of another well-known psychological effect, namely overreaction to information, such as media reports on upward trends in a given market. It has been psychologically proven that human behavior is subject to significant biases of various kinds. Examples of biases which typically influence the decisions of investors are confirmation bias, where the investor has a predetermined conviction and only pays attention to arguments which support it, and hindsight bias, where the investor believes that a certain, in reality unpredictable event was obvious and could have been forecasted. Consequently, hindsight bias makes the investor overconfident, which may lead to erroneous decisions in the future. Another behavioral scheme which may impact investors' decisions is referred to as gambler's fallacy. Here, the investor is similar to a gambler who believes that a series of negative results increases the probability of scoring a win, while in fact the probability of statistically independent events is not impacted by history. As a result, investors tend to, for example, maintain their investments in assets whose prices are plummeting, in the belief that the downward trend is bound to reverse. As you can see, there are several psychological mechanisms influencing the behavior of investors. As a result, prices of shares may change due to factors independent of the actual financial position of a company. A question arises if behavioral finance should be reflected in the financial strategies of companies. However, the question has no simple answer. Obviously, financial managers should be aware of behavioral factors influencing share prices. Certain elements of a financial strategy, such as, for example, decisions regarding dividend signaling, may take into account the findings which come from the study of behavioral finance. However, we have to remember that the main objective of financial strategic management is the maximization of shareholder value in the long term, and the effects of behavioral finance are typically observed in the short or medium term only.